Welcome to Third Wave Trading, trading kept simple at thirdwavetrader.com. I am going to make the following assumptions about you. You want to make money by trading. You know how to buy and sell stocks and ETFs with a broker. You understand what a candlestick represents within candlestick price charts. But you are not interested in too much technical details or analysis. And you want to keep things simple. You just want to know what to buy or sell, when to buy or sell, how much to buy or sell. If this describes you more or less, then welcome to Third Wave Trading at thirdwavetrader.com. Why am I doing this? Sometimes friends and relatives ask for tips on what stocks to buy. Now, just giving a stock name to buy as a tip is almost a sure way to lose money and friends. They will also need to know when to buy, when to sell, and how much to buy. But most people are impatient and do not want to listen to the gory technical details. So how do I provide sufficient guidance and avoid as much technicalities as possible? This is the reason for Third Wave Trading. Please understand that I am not a broker-dealer or investment advisor, and that trading by its nature involves risk of significant loss. You take responsibility for your trades and decisions. I'm merely sharing with you my ideas and what I am doing. Before we go any further, I'd like to explain the two basic types of trades, the long trade and the short trade. Long and short does not refer to time. In the long trade, you buy an asset with an intention of making money when the price goes up. Most people are familiar with this type of trade, so we will focus mainly on this for a start. In the short trade, you make money when the price of an asset falls. The mechanics of the short trade is slightly more complicated. That is why I prefer to focus on the long trade for now. All successful traders need to answer these four key questions. What to trade, meaning what to buy or sell. When to enter a trade. For a long trade, it means when to buy. When to exit a trade. In a long trade, this means when to sell. And then, the last question, how much to trade? Should you put your entire life savings into this trade? These are the four key questions all traders need to answer. I will now answer these questions from the point of view of the Third Wave Trading Framework. The first question, what to trade? In the Third Wave Trading Framework, any asset whose price can be charted can be traded. And preferably, this asset can be easily bought and sold. For example, stocks, precious metals, oil, and ETFs. To answer the next two questions, when to buy and sell an asset, I need to explain the ideal third wave long trade. Say the market has been dropping and then turns up as a wave 1. Not any bounce will qualify as a wave 1 in this trading framework. To qualify as a wave 1, certain technical requirements need to be met. But in line with keeping it simple, I will not bore you with the gory technical details. Once wave 1 is complete, we get a pullback in wave 2. Ideally, we should buy the asset at the end of wave 2. Then the advance resumes with wave 3. Ideally, we sell at the top of wave 3 before the asset price declines again. It is almost impossible to pinpoint the exact bottom of wave 2 and the top of wave 3, but we can get close enough to make good money. The Third Wave Trading Framework provides a buy box, which is the region where wave 2 will end with high probability. This is the area where you can buy the asset. The framework also gives us a sell box, the region where wave 3 will most probably end and the place where you should sell the asset. By now, it should be clear to you why I call this the Third Wave Trading Framework. Another time to sell the asset is when the trade does not go according to plan. This happens more often than not. Say, after buying an asset, the price falls through the bottom of the buy box. This means the uptrend is in question and we should sell the asset and exit the trade. The bottom of our buy box is our stop loss. I assume you understand what a stop loss is and that you know how to place a stop loss order. So in any third wave trade, you have a potential reward and a potential loss, your risk. If the ratio of your potential reward to potential loss is big enough, you can be wrong more often than right and still make money. And do not be surprised if we are wrong more often than when we are right. Suppose the trade moves according to plan and prices bounce out of our buy box and wave 3 is progressing nicely. While this is happening, the stop loss levels will also be raised. This will further minimize our risk. When the stop loss level exceeds our buy level, our trade is protected and we will not lose money. So even if wave 3 does not make it to our sell box, we still make money. Your potential loss also determines how much of an asset you should buy, meaning your position size. Say your potential loss on a stock is $1 and you are willing to risk losing $100 at most. Then you should not buy more than 100 shares of that stock. I personally will not want to risk more than 1% of my portfolio on any one trade. Other traders may be more aggressive and risk up to 2%. I will certainly not recommend that you risk more than 2% on any one trade. You can buy anywhere within the buy box, but there are 3 high probability levels where wave 2 can end as indicated by the red arrows. So these are the levels where we should place our buy orders. These 3 levels will be provided with the buy box. Without going into technical details, the first level is the top of the buy box, which is 0.382 times the height of wave 1. The second and third levels are 0.5 and 0.618 times the height of wave 1 respectively. To keep it simple, these levels will be indicated in the buy box and we won't go into the technical details. Ideally, you should buy as close to the stop loss level as possible because then it's cheaper and your risk is lower. The problem is that the price may not drop that far and you may miss a potentially profitable trade. So some traders spread their buy orders over the 3 levels or over just the 2 lower levels. Some may place an order just at the 0.5 level in the middle. Some more risk-averse traders may place their orders at the lowest of the 3 levels, prepared that they will miss some trades. Understand that there are no guarantees you will buy the asset at the lowest possible price. Having bought the asset, price could go even lower before turning back up. Before deciding to enter a trade, you may want to have an idea of the potential reward. In third wave trading, the potential reward is represented by the height of wave 3. Fortunately, in this framework, wave 3 often comes close to 1.618 times the height of wave 1. Again, there are no guarantees, although the probability is high. So the height of wave 1 allows us to estimate our potential reward. Now let me explain the reward to risk ratio. Recall our expected reward is 1.618 times the height of wave 1. Let us also assume that we had placed a buy order at the lowest of the 3 buy levels we had talked about earlier, and that wave 2 ends precisely at that level and our order was filled. In this case, our risk is 0.382 times the height of wave 1. Our reward to risk ratio is therefore 1.618 divided by 0.382, giving us 4.2. This is a very favorable ratio. This means that every 4 trades that go wrong can be made up with 1 that goes right. You don't have to be right all the time to make money. Of course, if you had made the purchase high up in the buy box, the ratio will not be as favorable. This is what a typical trade alert from me looks like. It shows the buy box and the 3 buy levels. It also indicates the initial stop loss level. This level will go up as the trade progresses. Finally, it will also show you the height of wave 1. This will give you an idea of the potential profit and reward to expect. Sometimes the price won't make it into our buy box. Instead, it bounces from here and exceeds the top of wave 1. If that happens, we will consider the buy box as invalidated. There are some exceptions to this rule, but I won't go into the technical details. The width of the buy box is arbitrary and has no significance at all. It is not meant to indicate when the pullback in wave 2 will end, nor when price will break out of the buy box. Focus on the price levels in the buy box and not the time duration. Let's summarize how the third wave trading framework answers the 4 key trading questions. What to trade? Anything that can be charted as price waves, and it has to be easy to buy or sell. When to enter a trade? You enter a trade when the price is in the buy box, when there's a favorable reward to risk ratio. When to exit a trade? We exit a trade in the sell box or when we hit our stop loss. Remember, our stop loss is raised as the trade progresses. How much to trade? In this example, your potential loss per share is $1. If you are prepared to lose up to $100 on this trade, you should not buy more than 100 shares. As a general guideline, I do not risk more than 1 to 2% of my portfolio on any one trade. That's it. You're ready for third wave trading.